all hear the constant chatter around the housing market, right?
Oh, yeah, it's nonstop.
Are interest rates up, down? What's actually happening with home prices?
It's confusing for a lot of people.
Absolutely. So for anyone navigating this or, just curious about what's really happening on the ground, today's deep dive is definitely for you.
Mm-hmm.
We're going to dive into the second quarter 2025 financial results from PulteGroup, Inc.
A really significant player in the home building world.
Exactly. And our mission today is, to cut through all the numbers and pull out the most important insights
From their earnings call transcript and the financial report they put out.
Right. We want to unpack what these results tell us about the home building industry right now, maybe consumer sentiment, and PulteGroup's own strategy.
Think of it as a shortcut, maybe, to understanding the pulse of the housing market through the lens of one of the giants.
Perfect. And yeah, our sources are straight from PulteGroup, the Q2 2025 earnings call transcript, and their official second quarter financial results press release. Both came out July 22nd, 2025.
Got it.
So let's unpack this, starting with the big headline numbers.
Makes sense. Where do we begin?
Okay, PulteGroup reported net income of $608 million. That results in earnings of $3.03 per share for Q2 2025.
Now, that is a decline from the prior year. Quite a bit, actually. $809 million in net income and $3.83 per share back then.
It is, but it's really important to note, last year's numbers had some, let's say, extra boosts.
Ah, right, the specific benefits.
Yeah, there was a $52 million pre-tax insurance benefit and also a $13 million tax benefit in that prior year figure.
Okay, so not quite a direct comparison then. And what's fascinating here, even with that year-over-year dip showing up, the company is really emphasizing strong financial results.
Right, and disciplined business practices.
Exactly. Which, it kind of begs the question, how are they defining strong in what they also call a highly competitive home building environment?
That's a good question. It forces you to look a bit deeper than just the surface numbers.
Definitely. It points towards their strategy, maybe.
That's a crucial point. So those headlines give us the overview, but let's look at the actual homes. What's happening with sales and closings?
Yeah, the activity on the ground.
So closings totaled 7,639 homes. That generated home sale revenues of about $4.3 billion.
Okay, and how does that compare?
Well, it's a 6% decrease in the number of closings from last year. They closed 8,097 homes then.
Right.
And it's a 4% decrease in home sale revenues. That was $4.448 billion last year.
So if we connect that to the bigger picture, it certainly suggests a bit of a contraction in sales volume, doesn't it?
It does.
But hang on, there's a really interesting counter trend here. The average sales price actually increased.
Oh, by how much?
By 2%. It went up to $559,000 from $549,000 last year.
Interesting. So fewer homes, but higher prices on average.
Exactly. It tells us they're selling fewer homes overall, perhaps, but maybe at a higher individual value, which could speak to the type of homes or maybe the type of buyers still active in this market.
Right, maybe moving slightly up market.
Could be, or focusing on specific segments.
And despite those fewer closings, you mentioned their disciplined PulteGroup maintained some really pretty impressive margins.
Yeah, talk about profitability.
Their home sale gross margin was 27.0%. Now, that is down from 29.9% last year.
Okay.
But, and this is key, it was consistent with their own guidance range. They expected something around this level.
So they hit their target even if it's lower than the prior peak. That shows control.
Absolutely. And think of gross margin as, the profit per house before general company costs. Holding 27% in this market is pretty strong.
Definitely signals operational control.
And even more notable, maybe, their operating margin hit 17.9%.
Wow, nearly 18%.
And get this, their return on equity. That's a net income over the last 12 months divided by average shareholders' equity. It was a really robust 23%.
Okay, 23% ROE. That's significant.
Yeah.
It basically shows how effectively they're using investor money to generate profit.
Right. Highlighting management efficiency.
And this is exactly where that phrase disciplined business practices really becomes visible, isn't it?
Seems like it.
Achieving a 27% gross margin, 17.9% operating margin in, a tough environment. It indicates really effective cost management and probably smart pricing strategy.
Right. Not just cutting, but being strategic.
Yeah. It tells us they seem to be prioritizing profitability per home, maybe over just sheer volume, which is a key indicator of financial health, especially now.
A focus on quality over quantity, maybe?
Could be. A sign of adapting, prioritizing profit in a market that's maybe less about first-time buyers right now.
That's a powerful insight into their strategy. But okay, financial health looks solid, margins are good. But what about new demand? New interest from buyers?
Yeah, the pipeline, what does that look like?
Well, net new orders for the second quarter came in at 7,083 homes.
And compared to last year?
That's down 7%. It was 7,649 homes in Q2 last year.
Okay, a drop there too. And the value?
The value of those new orders was $3.9 billion, also down from $4.4 billion.
Mm-hmm.
And the backlog, homes ordered but not yet closed, it stands at 10,779 units.
Okay.
With a value of $6.8 billion. And again, that's down from last year's 12,982 homes valued at $8.1 billion.
So we're seeing a clear drop across the board there. New orders, backlog value, backlog units.
Yeah.
So the obvious question is, why? What's driving this softness in demand?
Well, CEO Ryan Marshall touched on it. He mentioned consumers dealing with, quote, high interest rates and challenged affordability.
The usual suspects right now.
Right, and also macro concerns about the strength of the economy. People are just a bit uncertain.
Understandable. But did he offer any sort of glimmers of hope?
He did. He noted they were encouraged by the positive consumer response we saw to the pullbacks in interest rates in late June and at times earlier in the year.
So very sensitive to rate movements. Even small changes seem to matter.
It really suggests a highly sensitive market, where even slight dips in mortgage rates can spur some activity.
Interesting. And despite this softer demand picture, they're also doing something else, growing their community count.
They are, by 6% actually, to an average of 994 communities.
So they're expanding their footprint, opening new places to sell homes, even while overall orders are down.
Yeah, it seems like a strategic move.
It's a bit of a calculated risk, isn't it? Expanding inventory or reach while demand is uncertain. Betting on the future, perhaps.
That expansion, despite the softer demand, it does signal some confidence, right, in their long-term position.
Absolutely. Speaking of position, let's talk financial muscle, their balance sheet.
Okay. PulteGroup ended the quarter with a solid $1.3 billion in cash.
Good cushion.
And here's something really interesting for financial stability. Their debt-to-capital ratio actually lowered.
Oh, really? To what?
To an impressive 11.4%. It was 11.8% at the end of 2024.
Wow, that's low for a builder. That ratio, just for listeners, it basically shows how much debt versus equity they use to finance things. Lower is generally stronger, less risky.
Exactly, less reliant on borrowing.
And if we dig into the non-GAAP number, the net debt-to-capital ratio,
which adjusts for cash on hand.
Right, it was an incredibly low 2.8% at the end of June. 2.8%.
That's tiny.
It means they have way more cash than debt. That gives them enormous flexibility. Crucial in a volatile market like this. They can weather storms, maybe grab opportunities.
Like buying land cheap, perhaps?
Potentially. Or even M&A. Very strong capital position.
And with that strong cash position, they made a pretty clear move for shareholders.
The buybacks.
Yep. They repurchased 3 million of their common shares. Spent $300 million in Q2 alone.
At an average price around $100 a share.
And year to date, it's even bigger. 5.8 million shares repurchased for $600 million.
That's a really clear signal of confidence from management, isn't it?
How so?
Well, using that cash to buy back stock,
Uh-huh.
it shows they believe their shares are undervalued.
Yeah.
And it's a direct way to return capital to shareholders, boost earnings per share over time. A real commitment, even when the market's competitive.
Makes sense. Okay, let's not forget their financial services arm, the mortgage side of things.
Right, pulled mortgage. How did they do?
Well, that segment reported pre-tax income of $43 million.
Okay.
Compared to two. It's down from $63 million in the prior year.
And the company was pretty explicit. This was impacted by the lower closing volumes in the home building side.
That makes perfect sense, really. They're tightly linked. What was their mortgage capture rate? The percentage of buyers using Pulte Mortgage?
It was 85%, which is still very high.
Extremely high, but down slightly.
Yeah, just a touch, down from 86% last year.
Still, 85% capture is impressive. It shows how integrated that mortgage business is. They keep that financing revenue in-house for most sales.
Right. Boosts overall profitability per home.
But it also means, fewer home closings directly hit the bottom line of the financial services segment, underscores that cyclical nature.
Now, we talked about the overall numbers, but you mentioned earlier things might look different depending on where you are.
Absolutely. Real estate is always local, right? Even for a national builder.
So we see clear geographic variations in Pulte's results. For example, the Northeast actually saw an increase in closings.
Oh, interesting. Up.
Yeah, 451 closings versus 378 last year. And the Midwest, too, slightly higher closings, 1,272 versus 11,196. Okay, so some bright spots.
But in other big regions like Florida and Texas, closings were down.
How much down?
Florida saw 1,882 closings, down from 2,150, and Texas saw 12,218, down from 1,472.
Okay, significant drops in those key Sunbelt markets.
And that pattern, it's also visible in the net new orders and the backlog figures. Some regions, especially Texas and Florida, showing pretty noticeable declines in their backlog.
So what does this patchwork tell us? What's the takeaway for someone listening?
Well, it really hammers home that housing market dynamics are super localized.
Yeah, you can't just paint the whole country with one brush. National trends point one way, but the reality on the ground in Phoenix might be totally different from Philly.
Exactly. Understanding these regional nuances is key. And PulteGroup's strategy seems to reflect that. They talked about aligning home production and land investment to effectively serve today's current core demand.
Which sounds like they're adapting their approach market by market, not just building everywhere, but focusing where the demand, even if softer, is most resilient.
Right. And aiming to, quote, retain and grow our market share as demand strengthens in the future.
So playing defense where needed, but positioning for offense later. That market-by-market precision is probably how a big builder like them navigates such a complex environment.
Okay, so let's try and summarize this deep dive into PulteGroup's Q2.
Yeah, wrap it up.
We saw a company navigating, well, a pretty tough market,
Yeah.
but doing it with what they call disciplined practices.
Maintaining strong margins, keeping a really solid balance sheet, even though home closings and new orders did decline.
Right. They're clearly responding to that consumer sensitivity around interest rates and, broader economic worries.
Adjusting their strategy, aligning production and land investment to where the demand is now, maybe focusing a bit more on higher value homes.
And this analysis, it really shows us the home building sector isn't just about big national numbers.
No, it's about strategic adaptation. It's about understanding how consumers behave when the economy shifts, and crucially, how different local markets perform.
It gives us a really fascinating look at how a major player responds to real-world challenges using foresight and, frankly, their financial strength.
So maybe the provocative thought to leave people with is this. We see PulteGroup's strong balance sheet, their strategic alignment, but we also see that ongoing consumer sensitivity to rates and the economy.
Right, the big question mark.
Exactly. How will these conflicting forces play out in the second half of 2025? Will those recent little pullbacks in interest rates be enough to spark a significant rebound in orders and closings?
Or will affordability issues just keep a lid on the market's potential despite the builder's strength?
It's a really critical question for anyone watching the housing market right now. Something to keep an eye on.